Welcome to the third best decision you've made in your life. The first one, of course, being following me on Twitter. The second one is joining the method. And the last one is joining this seminar, quote unquote. Today, we will discuss time. We will delve a bit into the time aspect of the charts, because as we know, the charts are made of both an x-axis and a y-axis, right? In the previous one, we had discussed price. Pretty much more than enough for everyone to know about price. We did touch on time a bit, but we're going to go a bit deeper into the time aspect. Now, a few disclaimers to be made. Number one, this is not financial advice. We are simply discussing how to read price action, right? Which is how to anticipate candles, how they print before they print. Number two, if you find a single thing useful out of this video, which is going to be about 4 hours, I'm assuming, maybe less, divided into multiple parts, all right? If you can find one thing useful which you can implement into your trading, then you have succeeded. And the same applies, by the way, to any information you read on Twitter, on Telegram, me, ICT, whoever. Whenever you see someone offering information, you either classify it as useful or useless. It doesn't mean you have to completely understand what he's saying. You can take one little portion of what he's saying and apply it to your trading to become successful. All right? So that's important to note, which is, if I say 100 words and you can only make sense of 10 words and use those 10 words for your benefit, then you have succeeded. Some people might need to watch it twice, 3 times, 4 times, like the last one. The last one I had a bunch of people telling me that they didn't get it the first time, but the second time it clicked, right? Or the third time. And on the other hand, I had some people who were telling me that that it clicked straight away. So everyone is going on their own path. Don't compare your path to others, right? Some people are faster and some people are slower. But if you stick around long enough, then you will eventually reach the end of the race. Nice voice crack. Third of all, when you're learning a new concept, then you don't just go and watch it once, open, decline, rally, OTE, rally. You don't just watch it once and start putting your money on it, right? You watch it once, you watch it twice, you back test, you forward test, which is 10 times more important. You grow to trust the price pattern to an extremely intimate level, right? In a way which, even if I come afterwards and tell you, you know what, it's going to do this, you're going to say, no, you're wrong. I think it's going to do this because I've seen it this many times and I trust it to do this in this way. And nobody can deter me. That comes with practice and consistency. Don't be the idiot who tries once, fails, and says, fuck this, let me try something else. Tries once, fails, another strategy. Strategy hopping, which is the majority, and the majority are losers, right? Further disclaimers. But this time I'm going to tell you what this is and what this is not. Now, this is a... That's right, is not. This is, and I know these parts bore a lot of you, but you got to deal with it, right? The boring stuff is what matters. And I'll leave some timestamps for those who are too lazy and want the strategy straight away. This is a study of price action, right? This is a discussion of how charts move. And you can use it for whatever you want. You want to trade with it. You want to simply, it's a hobby for you. You want to, whatever, right? Each one of you who's watching is free to do what they want with this information. What this is not, it is not financial advice. It is not enigma. It is not the key to $100 billion, right? Nope. It's simply a study of price and a deeper delving into, not the deepest, but deep enough delving into time and turtle soup, right? Now, prerequisites. Prerequisites. In order to benefit completely from this material, you have to be at least familiar with ICT's concepts. Again, I'm not in most of the stuff, ICT has taken a lot of the knowledge which existed beforehand and summarized it into his little smart money concepts, right? Which is why you can say that I use his stuff for most of my trading. So he should be considered your source. And me, I am a supplement. Right? Number 2, preferably you have taken the method, which is level 1, details with secretary in the pinned messages of the Telegram account, which exists at the moment of this recording. And third of all, you must have the will to learn. Because without these 3 things, especially number 3, you will never make it, and you will fail. All right? Now, stop recording. Nope. Remove all drawings. Of course, credits to whom credit is due. ICT, Chris Laurie, Larry Williams, WD Gann, Elliot, Richard Wyckoff, and whoever else contributed to the accumulation of knowledge of price which we have today. And before any of you bought, say, ICT this, ICT that, go and read about everyone else, right? And many more, by the way, right? These are just some major notable people. But before you open your mouth with parroting nonsense, and this is specifically at a few people, then go study and read the other people which existed in this field, which is trading. After you have delved deep into their content and seen and you've measured out the battlefield, you've seen what's going on, you've seen what each person offers, then you can open your mouth, not before. Anyway, now we delve right into the topic. The importance of time. Why is time important? Importance of time. Why is time important? To demonstrate the importance of time, I like to use the good old example, right? Which is classic, age-old example, which is John bought Bitcoin at the price of 13,000. John suffered an instant 50% loss from his purchase price. Right? Ali bought Bitcoin at the price of 13,000. And Ali, or Ali in Arabic, made an instant gain of 3x. They both bought at the same price. The only difference was the time of the purchase, right? Now, if that went over your head, then rewatch it again and realize the importance of that, right? So they both bought at the same at the same price level. The only difference was time, the time of purchase. Which is why we say time is more important than price. Are you buying at the correct time? Because the price could be right. But are you buying at the correct time or no? Now, how do you define the correct time? There's multiple ways, right? You can do it through price or through time. Before we get into it, let's first talk about the divisions of time. The divisions of time. When I say time, then I'm referring to either the open, high, low, and close, the IPDA data ranges, time cycles, and important dates for swing traders. Important dates. Right, so to the day, a certain day. For this teaching, we're going to be focusing on the open, high, low, and close aspect of time, right? Which by itself is an extremely complete approach to time, right? The IPDA data ranges, which are not only by ICT, by the way. There's a certain person he took it from, right? Refined it, quote unquote, and claimed it as his own. IPDA data ranges. The algorithm which is being marketed as having been coded, whatever nonsense that is, simply just copy-paste from X, copy-paste from Y, and boom. Call yourself the engineer of the algorithm. Real cool. For these, I may be talking about these in the future, but the core content has a good, by the Inner Circle Trader, it has a good teaching about them. For now, we are going to be focusing on the open, the high, the low, and the close aspect of time. These two, you can forget about them for now. Now, what is the open, the high, the low, and the close? OHLC or OLHC, right? This is for a bearish candle. The open, the high, low, and close. And the open, low, high, and close is for a bullish candle, right? The open, high, low, and close, and the open, low, high, and close. Now, this is the basic anatomy of the candlesticks. Right? This is how candlesticks are formed. This is not new information. Everyone knows this. What matters is how do you use this? How do you use this to predict a certain candle or the other, right? That is what we are going to say. Now, there are two main theories, which is each candle is divided into three parts. Right? Accumulation, manipulation, distribution. And the other one says each candle is divided into four parts. Right? Whichever one you want to believe in, it doesn't matter. What matters is how do you apply it, how do you use it. I personally like to believe that they consist of three parts. So I like to see accumulation in one candle, manipulation in the second candle, and distribution in the third candle to the first candle. All right? If it takes a bit longer than three candles, so accumulation in one, then manipulation in two, or accumulation in two, manipulation, distribution, so be it. As we know, accumulation is the longest phase. Or you can also say accumulation, manipulation, distribution in two. Right? So realistically, what you're looking for is three higher time frame candles to trade. And I will delve into that a bit deeper. But for now, let's focus on the aspect of the open, the high, the low, and the close. Now, let's dissect the OLHC or OHLC. We have two fixed values, and we have two moving variable continuously changing values. Right? So the open is fixed and the close is fixed. What varies is the high and the low. Right? I've mentioned before that each candle has three trades inside of it. So you got the open, the high, trade number one, trade number two, OTE, trade number three is the opposing end of the candle. Visualizing that is as follows. You got the open, opening range, remember? A high, breakdown, OTE, and low. So ideally, you're trying to trade a higher time frame candle with this premise in mind, right? Whether it's a daily candle, whether it's a weekly candle, there's a fixed opening time, right? And there's a fixed closing time of the candle. And there's a fixed midpoint time. Which is why you might have heard me tell you a lot of times, which is the high of the day until London, until New York. The low of the day is in until the NY session. Right? The high is in until the NY session. Why? Because you might end up expecting a trending candle, but it is in fact the high of the day during the time, which is London. It declines and then it reverses instead of continuing and ends up being a choppy, ranging candle. So you're expecting expansion, right? But you got more accumulation. And this is a fun fact. The markets spend more than 70% of the time accumulating, which is why a common mistake, which you may have committed by yourself, is trying to enter a position and then holding on for too long, and it comes back to your entry. Why did that happen? That happened because you were expecting expansion during an accumulation phase, right? So that is an important thing to keep in mind. More than 70%. Of the time, the candles or price is in an accumulation. Some assets more than others, but overall, it's more than 70% accumulation, which means you're going to spend most of the time waiting for the setup anyway. But, of course, we're trying to focus mainly on trying to get to predict or to participate in an expansion candle on the higher time frame. That's the goal, right? To simplify everything, right? To make it really nice and short and sweet and simple. All you're trying to do is enter up here. So the opening price, which is a fixed value, as soon as the fixed opening time provides you with the opening, right? So as soon as the Monday candle opens, you have the reference already, right? So the puzzle is already 50% solved. The open, the high, the low, and the close, right? You got the open, and you got the close. All you have to do now is anticipate the high and the low. Doesn't have to be the absolute high, doesn't have to be the absolute low. If you can catch a high until half of the candle, or just this portion, right? I know one of my students, quote unquote, this is their model, which is catching this trade number 3. There's 1, there's 2, and there's 3. This is all they trade. So they let the whole thing play out, and they finally catch the final bounce off the range of the candle, right? Now a pause. If this is too advanced in your eyes, then you probably should put this aside, go and study a bit, and then come back to this later on, right? It'll make sense. For the rest of you, I'm sure, are following along as you should, because I had put as a prerequisite to be intermediate to advanced, right? For your own benefit. If you snuck in, whatever. But if you really want to make use of it, then a quick reminder that you should be of the 2 categories which I specified are allowed to enter. All right? Now, this whole thing, this open, high, low, and close, the 2 main candles we're trying to predict or play with are the daily and weekly range, right? Which is also why good old ICT says that his whole purpose is to try and predict the outcome of the weekly range. That is what one shot, one kill is. Remove, 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 remove. Now, to put it really, really extremely raw and just the bare bones idea is open, right? Accumulation, a little bit. Manipulation, and distribution. And every single one of those is done on purpose, by the way. Every single arrow you see is done on purpose, right? Open. Above the opening price of the candle you're trying to predict, daily, weekly, 4 hour, whatever. If you are bearish, you're waiting for a pop above the opening price. And here's the fun part. Into a previous high of the previous candle, which ideally coincides with a higher time frame key level. All right, twisted candle. A liquidity pool inside of a higher time frame PD array. Above the opening price of the candle you are trying to trade. From there you enter and you write it down to the opening price. The SR flip of the opening price and onto the rest of the duration of the candle, right? And of course it bounces off the lower end of the range, also off of a key level and a liquidity pool, right? Either an existing liquidity pool or a newly formed liquidity pool, right? That's the basic idea. Right, so if this is all you take from the whole lecture is open, rally above opening price, key level, decline, key level, that's it. Trade number 1, trade number 2, trade number 3, all right? If this is all you take from this, then I consider you a success. Now, let's go and see how this plays out on each candle, starting from the monthly, down to the weekly, down to the daily, down to the 4 hour for intraday, down to maybe the 1 hour. But for sure, the monthly, weekly, daily, and 4 hour. You can go below, of course. You can trade the 15-minute power of 3, but that's if you can't even trade the weekly, then what are you doing with the 15-minute, right? So let's get right into it. Let's start with the monthly power of 3, right? All right, folks. Now, talking about the monthly power of 3. we've mentioned before that the open and the close are fixed values, right? And the high and the low are the moving values, right? Monthly power of 3, we look at it through the 4-hour time frame lens. Now, so this is Bitcoin, a recent move I'd called. We pull a fib, we look at the 50%, and this is going to be a blend of time and price, all right? Because as we know, the famous picture, which is quite true, the picture which says price levels are useless until time is considered, and time is of no use unless price is at a key level, right? When you blend the two, of course, then you get a pretty good result. So now let's focus on the monthly, of catching the monthly range. Open is fixed, close is fixed, right? And we're trying to catch either the low or the high. So right now on Bitcoin, we were bullish. We were expecting it to be drawn to the higher time frame. And before I continue, let me just mark the draw on liquidity on the higher time frame, which is this monthly FVG. All right. So the magnet for us is up here, right? And the reason I've been more focused on Bitcoin, if you've noticed, is it was offering pretty clean. It had a pretty clean bias ever since down here. I've been calling for 32,000, right? So over here I said 32, over here I said 32, over here I said 32, and here as well. I'd kind of semi-slipped a bit, calling it here instead of here. But over here, I had demonstrated an important thing, which is sticking to your bias until it is invalidated, right? Which I'll speak about too. But the point is, the reason I'm focusing on Bitcoin so much is because the higher time frame is pretty obvious. The drawn liquidity is 32,000. We are looking to buy retracements until we reach 32,000, right? So, keeping the higher time frame draw liquidity in mind, we have opened a new candle on the monthly, right? And the previous month's candle has engulfed the month before it candle, right? But it never closed below the low. You've seen me emphasize, if you've been following me for a while, on the closes below lows and above highs, right? So this monthly candle closed as an engulfing candle. Replay. I'm clearly not used to this device or replay. I usually watch the data live. So this month closed, right? So pretty bearish, no? You would think, but no. The bias is up here. We're expecting this to be the magnet, if you will. It did not close below this low. If it had closed below the low, then you could start considering bearishness. But it refused to close below the candle, and it is bumping into a higher time frame key level, the FVG, and the inverted FVG as well, right? So there was no reason to be bearish. Now, of course, then you pull your fibs, you look at the premium discount, and this is where I delve into how to frame a trade idea on reading price, not trading. Because this is not financial advice. This is only price action reading for fun, right? So again, there's refusal to close below this low as well. The swing low that broke the high. Those are important key levels I've mentioned before, which is the lows that break the high or the highs that break the lows. Those are super important key levels when closed above or below, or falsely closed above or falsely closed below. And backtest that. Rewind what I said just now. Rewind it, listen to it once, twice, 3 times, and backtest it. So we have this important low. We have this key level, the IFVG. We have the old high as well, a classic SR flip price action. And this is where I called right over here. I'd call for Bitcoin to go to 32,000. First target is over here, and second target is up here. Now, what happened? We dug a bit deeper before eventually rallying to the targets, which was 1 and then eventually 2 coming soon, right? How would you frame a trade idea? You want to first have an eye on the target, right? So my eye was up here. So the first thing you want is a draw on liquidity. This is how you frame the bias. I had given out a tweet in written form, but I think a video form is a lot more useful. So number 1 is, where's price? What's the magnet? Where do you think price is going to be drawn to? Either up or down, right? Second of all, what potential entry points do you see? Right? Third of all, what is the opposing end, or what is the other side of the draw on liquidity, which you are considering in your assessment highly unlikely to be reached before the draw on liquidity? Let me say that again. What's the point in price which is highly unlikely to be reached before the draw on liquidity is reached, right? That is your invalidation level. So, right over here, we had number 1, which is, where is price likely to be going to? 32,000. That's the I. What is a potential entry? Over here was considered. Over here was considered. These were the 2 entries given, right? What is a place you deem unlikely to be tapped before the target? This liquidity pool, highly unlikely to be tapped before the drawn liquidity, especially given that it is a 0.618 fib and we are in an uptrending market, tapping into the 50% Fibonacci level. Right, so this was reasonable stop loss for the idea to frame the bias that we are going to be rising up there. So this is one. Where is the drawn liquidity? Number two, what is the entry? 50%. Below this low, add the 50%. The old high, the monthly, remember, the monthly FVG, the monthly IFVG, week 2 of the month, right? Which I'll be getting into right now. And number 3 is which point in price is unlikely to be reached before the drawn liquidity? Invalidation, right? And that is how a trade idea is birthed, right? It's funny using the RR tool, but this is all called in real time, right? If you had picked this, the low of the FVG, then sure, it would be shittier risk to reward, but you would still be correct, right? Now, this alone is enough. However, there is an important aspect, which is the divisions of each candle. Each candle is divided into 3, or you can say divided into 4 as well. I like to use 3 on the daily candle and the weekly. And I like to use 4 on the monthly candle. In fact, you can use this dissection of any higher time frame candle as a 3 candle process. So you don't need any more than 3 candles to trade, right? You can trade this candle. You can choose 1 candle at a key level, 1 candle at a key level. 1, 2, 3. 1, 2. That's your whole trade, right? And things are getting close to be interesting very soon. So, keeping that in mind, we have the monthly candles power of 3, the monthly open, high, low, and close. The monthly candle has closed as a bearish candle. In a bullish market, in a clearly, obviously bullish market, disrespecting bearish PD rays, respecting bullish PD rays, in a bullish market, a bearish candle is going to be engulfed in the next candle. In a bearish market, a bullish candle is anticipated to be engulfed in the next few candles, right? Retracement, protraction, expansion. Expansion, protraction, expansion, right? So this bearish candle, we're expecting a higher time frame, remember? So this alone is a trade. Keeping in mind the order flow, the narrative, the whole context of the move, you're trading 1, 2, 3. Candle number 1, candle number 2, and candle number 3. Right? From the lens of power of 3, you go to June, you go to the open, you want to buy. Again, what were the rules? The rules were buying below the opening price when bullish and above the opening price when bearish into a higher time frame key level. Blend that with what I said just now of how to frame a trade idea. And you get a pretty accurate read on price. Right? So below, we're forming a range. We're forming a range below the opening price. We're breaking out of the range. This is all a wick entry. What does that mean? What does wick mean? We always say enter with a wick, right? What is the meaning of entering in the wick? It is simply entering below the opening price when bullish, entering below the above the opening price when bearish. All the order blocks, all the breakers, all the OTEs, everything is happening over here, and you're riding it back into the opening price and potentially a flip of the opening price and a continuation lower, right? This is how you get the wick entry. Same over here. Open, decline into key level. This is all happening below the opening price, right? You're waiting for the order block, the range, the breaker, the OT to form below the opening price at the certain time required, and you write it up. And you entered from the wick of the candle, right? Not to stray too much, but in summary, opening price fixed, closing price, opening time, fixed, and closing time is fixed, right? The previous candle was a bearish candle in an uptrend. Bearish candles and uptrends are to be engulfed. We've reached a key level, right? So we are at a key level. The narrative, the context, everything is in aid of a push higher. Blending that with the opening price, we're bullish, right? What do we say? A candle opens, we dump, we create a range below the opening price. We then break the range below the opening price, and we rally. That's cool, but here's a question. How do you make sure that you weren't tricked into this being the bottom, right? You could have well and easily done that. You could have bought here, turtle soup, right? And then you could have been suckered in and stopped out before the move. That is possible. That can be avoided by two ways. Number one, always wait for the confirmation of the high being broken, right? Whether it's the opening price being flipped or it's the high that broke the low being flipped, all right? Or you can simply wait for the sections of the candle to play out as they're supposed to be. As I mentioned before, you got 1, 2, 3. Accumulation, wait for week 1 to accumulate, week 2 to manipulate, and then week 3 you're looking for buys. All right? Accumulation, manipulation, distribution. Let's see what that looks like. Week 1 is done. Week 2, accumulation, manipulation, distribution. Right? So again, you're noticing I'm switching back and forth through 2 time frames, and that is super important. The higher time frame to give me a draw on liquidity, a magnet, and the lower time frame to find the entry patterns, quote unquote. Right? Now, the time has come. The time has come for me to show an even deeper understanding of this accumulation, manipulation, distribution, which I just mentioned. The higher time frame candle being divided into sections, right? And you can use any 3 of them: accumulation, manipulation, distribution. You can go back to the video, the previous, not this one, the one before it, right? Not the one before this one, the one before this one, right? Where I talked about the 2 ways this can play out. But the basic premise is an accumulation candle, a manipulation candle, and then candle number 3. You want to ride the wave of the candle back to the high of the candle that was turtle souped. Let's take a break, and we will get into a nuance, a detail, which I haven't really mentioned before, but let's mention it now. Let me just take a break, a couple of minutes, and I'll be back. So I'm going to stop the recording right now and leave you on suspense mode. All right, folks, we're back. Now, again, we've agreed that the basic premise is the open, high, low, and close. The opening time is fixed. The closing time is fixed. When you're bullish, below the opening price, you're expecting, of the candle you're trying to trade, right? You're expecting a range to form, and then a change in the state of delivery, whether it's breaking a high, whether it's closing above a down close candle, whether it's an OTE, whatever, right? You're expecting below the opening price of the candle. So the opening time is there, opening price, expecting below the opening price, a range to form, CSD, and you rally. We can narrow things down even further by saying we wait for the first quarter right, of the candle to finish, which is why we skip Monday, which is why we skip the first half an hour, which is why it's 9:30, not 9, which is why the Judas comes at 2, not at 0 GMT, right? Which is why we wait for week 2, not week 1, which is why we use week 3 as a continuation of the reversal that happened in week 2, right? So open the open, high, low, and close. The candle opens. The first quarter of 4 quarters, or 3, and I've mentioned the use of each before. You wait for this portion. You wait for a range, an accumulation to form. You wait for a manipulation in week 2 of the month. Manipulation. And then week 3 and week 4, you watch for a distribution. Me personally, I like to be done by week 3, right? So as I said before, I'm usually looking to play a 3 candle formation. If I'm waiting and planning a trade for a long time, then I will catch it from week 3, from week 2, and hold it to week 3, 4, 5, 6, 7, 8 to hold a long-term swing high or swing low, right? The confidence to hold is going to come from the IPDA data ranges, right? And I'm going to link each one of these videos to a picture, a sample size, an example picture in the chat, all right? But anyway, for the sake of this teaching, quote unquote, and I say that because I don't really see myself as above any of you, right? At the end, I'm a student of the markets, as are all of you, always learning. Maybe a bit more advanced, you can say, but I don't see myself as better than anyone because of it, right? So I'm waiting for a candle to accumulate within this larger candle, right? Waiting for accumulation, manipulation, and distribution, right? If you miss this, then you can trade towards a certain draw liquidity which you framed beforehand. After the manipulation, you can be looking for buys. If you ever heard someone on Twitter, right, whether it's ICT or someone else, some other credible sources on Twitter, which are very few, if you've heard them saying the term looking for sells, looking for buys, then 9 out of 10 times they don't know what the fuck they're talking about. However, this is what it means. We have manipulated, and we're clearly drawing towards a certain point, right? That is when we look for buys until that point. Where? At key levels. 50% below the opening price, order blocks, FVGs, breaker, whatever. But that only happens after the manipulation, during the distribution, right? So applying this on Bitcoin, what happened was precisely that. We had the open, the fixed value. We had accumulation, manipulation, looking for buys, distribution. I like to buy at the manipulation phase, as you know already, right? Open, key level, low, high, close, right? This is my entry. However, the whole point of this section of the teaching is that you're trusting the low formed during that certain time to hold, whether it's week 2, whether it's Tuesday, whether it's London. I've mentioned before that a good place to put your stop loss is Tuesday highs and lows. London highs, what the hell is this? Goddamn. Tuesday highs and lows, London highs and lows, week 2 highs and lows. And that brings us to the concept of the high of the candle until the middle of the candle. Right? If you follow that, if you follow the idea that, you know what, I have caught the high of the candle, not this one, but because this one was a clear, strong, bullish bias, 232,000. If you can bear in mind, if you can have this framework in mind, which is I'm going to catch the high of the day till New York, I'm going to catch the high of the week till Thursday, till Wednesday even, right? I'm going to catch the low of the day until 9. If you play the game with that in mind, then you will find a lot more winning trades in your favor. Right? So instead of course, this is something I'm saying, you better be writing it, which is catching the low of day, high of day, whatever, until the 50% of the duration of the candle is reached, and then you take it off. What does that look like? A refresher. I've shown this before, but for the lazy ones who are a bit slow, right? You're catching this until this, and you're having enough because maybe you were mistaken by the positioning and you're actually in a bullish environment. Then what are you going to do? Then it's going to go and it's going to wreck you, right? Using your stop loss as a support level later on, right? At the 50% of the candle, of the time of the candle. So trying to catch a low of day, high of day until half the candle, until the NY session, is a model by itself. So anyway, let's focus on let's finish up with the monthly candle power of 3, the open, high, low, and close. The model I was mentioning, which I've been mentioning for a while, is I'm taking a higher time frame candle and I'm looking for a range to form at the high or the low of the higher time frame candle. And I'm trading that range to the opposing end of the higher time frame candle itself, which is 1, 2, 3 candle formation. So this model I'm talking about right now, this is the higher time frame candle, right? This is the time for manipulation to occur. This was a beautiful classic, and classic only happens during classic buy candles. You got this, you got opening price. We're below it. We never bottomed out till the second section, second quarter of the candle, right? The manipulation phase, because there's always an opening range for the candle. Sometimes it's less, sometimes it's more, depending on the average range of the candles. or the amount of pips or points it is going into a Judas, right? Which you can measure using, for example, if you're trying to measure a Judas on a Thursday, then you can reference the Judas that happened on the Wednesday before it, and Tuesday and Monday. So accumulation, manipulation, distribution. You've heard me mention before a lot of times, I'm looking for a thick, heavy, high volume candle. Let's see what that is. This is a range. This is a timed range. This is week 1. This is candle number 1. Right? Week 1 of the month. We're going down. And we're looking at this thick, heavy, high volume candle. So the higher time frame candle is having a thick, heavy volume candle at the end of the range. And in that range, I'm looking for my range to form. When this turtle soup happens, because we know time and price are both fractal, when this happens, then bingo, I have my entry right here. Even using a blind entry, which I call, if you have the range right, you can use a 1 to 2, 1 to 3, right? Let's say you use a blind 1 to 3, assuming you're going to use this knowledge to trade, rather than just read price, which is what it's being distributed for. You're taking this 1 to 3, the range on the lower time frame, you're blending it with the range on the higher time frame. And this is how I get my best trades. It looks funny, of course, now, but those of you who know, I actually held this trade all the way up till here. For those who've been following on Twitter, it looks ridiculous, of course, but if you think about it, if you think about what I just told you, looking for a lower time frame range, not during the accumulation phase, the manipulation phase, looking for a lower time frame range beneath a higher time frame range, using the lower time frame range's risk for the higher time frame range's reward. All right? Of course, you know me, if you've been following me for a while, you know I make fun of these RR tools, right? But if there is a realistic way of doing it, it is this. Right? It is the way I'm doing it. It is what I do. It's probably what I will always do, right? Looking for a lower time frame range at a above or below a higher time frame range, keeping in mind order flow, narrative, context, and bias. So that is one. If you remember, to even to dig in deeper on this piece of price action, I had also just beautiful. If only Twitter hadn't removed. If only it hadn't removed the bragging function. The bragging function. Where I got one right over here. If you had noticed, I had also called a bottom, quote unquote, right over here. Now, why was that? Again, the same exact idea. You got this higher time frame candle. Candles are ranges. So if a candle is a range, I'm looking at the low of the higher time frame candle, which is a range, for a range to form at the low of the higher time frame candle. And that is precisely what I got. A lower time frame range, right over here, always the same, never looks any different. A lower time frame range with a lower time frame range's risk. Eyeing the previous higher time frame candle. Now this model, which is which I've been discussing for half an hour now, possibly more, which is 1, 2, 3 higher time frame candle, and not just any candles, right? Open, accumulation, manipulation, distribution. Open, low, high, and close. Open, high, low, and close. Looking for cells in this one, which also has within it an open, high, low, and close. A good practice to have, whether this is, and this is where things will serve you well if you take this information through a hefty backtesting session, whether this is week 2, whether this is Tuesday, whether it's 2 a.m., whether it's 3 a.m., right? Whether it's 9:30, whatever. Whether it's the 9 o'clock candle, whatever this is, the whole idea is to take this higher time frame candle at this specific time, accumulation, manipulation, distribution. A good practice to keep in mind is to target the 50% of the candle, TP1, and the opposing end of the candle as a TP2, right? I've mentioned 2 models in this specific recording. You can take one single sentence of what I'm saying, or a few minutes to be fair, and make it your own model, right? I have many of you who are doing that, who are taking some of my words, some of my logic, and using it as your model. That is precisely what you need to do. Right? Don't get lost in all this. If it seems too much, then don't feel lost. Simply choose one which you resonate with and make it yours. Those will win. Specialists always have more value than general practitioners. All right? So whether it's a 3 candle, week 2, Tuesday, true day open, right? True session open, which I will talk about in the next few recordings. The idea of a true session open, it's been mentioned a couple of times on Twitter, even by ICT himself. I will be shedding some more light on that topic when it comes to the daily candle. But for now, this is all within, by the way, we're still in the monthly candles power of 3, right? And as a side dish, you've been served 2 models, which is the higher time frame, looking for a lower time frame range above a higher time frame candle during the specific time, week 2, Tuesday, etc. Or simply taking a 3 candle formation, right? Taking 3 candles first to the 50%, and this will give you a ton of trades, by the way, or to the opposing end of the candle. Let's go to the month. You got the accumulation, manipulation, and distribution. Every single buy when you're bullish should be below the opening price of the candle you are trying to anticipate. So I was expecting a bullish candle on the monthly. So every single potential entry is going to be below the opening price, right? It all goes back to, all this noise aside, it goes back to the basic idea, which is the opening price. We fall below it. We create a range below the opening price. We ride it back to the opening price, potentially flipping the opening price breaker, quote unquote, and rallying higher. Candle 1, candle 2, and candle 3. Of the same higher time frame candle we are trying to predict, right? So that's a monthly, PO3, right? Week 1, week 2, and week 3. Week 4 is probably going to be a chop fest, which we avoid. So we stick to week 1, 2, and 3. Except if we're expecting a ranging higher time frame candle, then what do you do? What happens when you have a ranging monthly candle, for example, where it's going up and down and up and down? Then you can expect a range to form, which will have week 1, accumulation, week 2, manipulation, week 3, distribution, but not exceeding the opposing end. It's not accelerating towards the opposing end of the expansion. Now, how do you put that in a visible picture form? It goes like this. And it always leads back to the same higher candle premise, right? The higher time frame candle premise, which is week 1. We had a range on the 4-hour, for example. Ranging. Week 2 was also ranging. and then it hit week one's candle in week two, leaving below equal lows. Do you see how much more sense that makes than simply equal lows and false break? Nope. It's going above the opening price, right? Leaving equal lows in week one, taking week one's high during week two, the time designated for manipulation, and then distributing either during week two or we look for sells in week three to the equal lows within the context. And this is not just some fancy talk. This is literally price being called and will be called live as long as I am on Twitter. All right? This one right here, same logic. This one here, sticking to the bias. Remember, you go back, how to frame a bias. Take this away. Entry, stop loss, target. A side note, it might seem like a lot at the beginning, right? Like, what the hell is all of this? But once you take one of these pieces of information, you make it your own, you apply it by yourself in your own charts, then you won't even need my opinion anymore, right? You'll just need the information you took from here, which you made your own, which you chose out of all the 2-3 hours, whatever, even 6 hours in the previous one. If you can take one piece of information and make it yours, you have succeeded, all right? Now we move on to the weekly candle. All right, folks. Before I start with the weekly, I'm going to reveal something, which is candles are ranges. That's it. Candles are ranges. Ranges are either turtle souped or they are truly broken. Now, what does that mean? That means as follows. This candle was a range. All right, let's choose a simple one to begin with, because when you're learning something, then the simple version is what you should be learning first, and then moving on to the more advanced version, all right? This candle, this specific order block, for example, was a range, is a range. This whole thing. As soon as we close above or close below the order block, or below the order block, when we close above or below a candle, it indicates continuation. When we wick, but we don't close, it indicates a reaction either for a reversal or a retracement, all right? We close below the low or above the high. So over here, we close below the low of the candle. It leads to a dig back into the candle and continuation. All right? So candles are ranges. And I hope you're taking notes, by the way, because I talk a lot, right? Because there's different styles of teaching. I talk a lot, and I'm expecting you, the listener, to take notes. Otherwise, you're fucked, right? Because I will point out the important stuff, but if you don't take notes the first time, you're probably going to end up taking notes the second or third time, or you're going to be forced to listen again to understand. So take notes and listen properly the first time, and you will be good. So candles are ranges, right? A range is either broken truly or broken falsely. When we close above or below a high, close above a high or below a low, equals continuation. All right? When we wick but we don't close, equals reversal or retracement. Continuation of the close, right? Don't mistake it for continuation of the trend, because that depends on the higher time frame order flow. Wick but no close equals retracement / reversal. This especially applies to my 3-candle model, the 3-candle pattern model, which you'll be seeing more examples of right now in the weekly range, right? Let's see. Right here, we had a higher time frame range. We dig into an extremely old liquidity pool. 3 months low, previous 6 months low, previous 12-month low. These were important landmarks. We dug into the previous, I think it was like a 9 month low. One of the highest probability models you'll ever find is taking all liquidity, right? Taking all liquidity and transferring it to a recent liquidity pool, right? What does that mean? Old liquidity pool to a recent old liquidity pool to a recent liquidity pool. All right? We're digging into this low. So the highest chances, the high that led us to that low is probably going to be taken out right here. All right? But how do you enter that? You enter that one of the ways, either a blind entry or a higher time frame entry, or you can wait for the model to form. I'm waiting for a candle. I'm waiting for my good old 3-candle pattern, right? Let's wait for this thick, high volume candle to form into the liquidity pool, preferably, right? Right here, you see this? Below this candle is a key level, the opening price of the order block, right? So keeping in mind this weekly candle, we're trying to take, assuming we don't close below this week's candle, we're going to be looking for buys these 2 weeks until we take out this candle's high. If you go back a few episodes, then you'll notice this is exactly the pattern I spoke about. Pattern with a logic. Weekly candle, 2-hour time frame. Check this out. So we're below the range on the higher time frame, right? We're looking for a range below the range. And a range will show itself to you. You will never, if you force a range, you're going to fuck it up. A true range will show itself to you. You will never need to second guess, is it a range, is it not? Nope, it's going to be right there. So this, where's the week? Weekly candle up until here. Accumulation, right? Chopping around, up and down. Let's draw this one too. So over here, this would be week 1, accumulation, manipulation, and distribution. This is all working inside of one candle. Week 1, week 2, week 3. This is all happening within the same candle, right? And things are getting super fun as we delve deeper into the lower time frames. Looking for buys. Blend this with order flow, with the market profile, breaking highs, dumping below lows, rallying. But forget that for a second. Even below this low, right? So we have this range here. Below this range, into the key level, there is a smaller range. This was my entry, right? This is one shot, one kill. You really pick your shot. There you go. Beautiful. So below this range, and not blindly below the range, there's a time and place. So we had, this brings us, of course, to the classic Monday range trade. What is a Monday high to low trade, right? There's two very famous models, which everyone talks about, and nobody knows how to trade, which is the Monday range and the Asian range, the Asian range high to low. Right? This is the previous week's candle. We are below an old liquidity pool. We're expecting a bottom to form, right? Week opens. Normally we expect Monday's range to play out. We don't play on Monday. Monday range plays out. Below the weekly open, we're expecting a range to form and a change in the state of delivery through an order block or a breaker, right? Below the opening price. Opening price, decline. This is a clear, defined range occurring when, by the way? Let's see. First of all, this is the Monday range, right? Just to visualize what it looks like. This is a Monday range play, what it looks like. Right, this is the range of Monday. On Tuesday, right, you can skip all this chop fest and start hunting at 3, which is what I do, which is the exact time a swing point is expected to form during London, right? Because you got accumulation. What's the time per manipulation in a daily candle? And I'm hitting 2 birds with one stone in this one. the time for manipulation is 2 a.m., right? Which means the time the swing high will form is 3. Well, 2:50 to 3:10, right? But 3 a.m. is the swing point formation time during that candle. 3 to 5 is a good place to, a good range of time to place your bets during. But I digress. You look for manipulation to form. Let's stick to the rules of the book. Let's not be rebels. The time itself is of the candle is 0, right? However, what usually happens is a bunch of chop, and you can start looking for a manipulation starting from 2, which is the classic, the by the book way, right? After 2, we decline into the previous day's low, Monday's range played out, remember? And we ride it, as I mentioned before, to the 50% and a violent retracement at 50% and to the high. That is also a model by itself. Monday low to high, Monday high to low. Backtest that one with this visual form. Below the weekly low. Right, so that is an example of a timed range model. The range is Monday. You're timing the Monday range. You're going to soup the Monday range by Judas, watching for it after 1 a.m. or 2 a.m. Or you can do what I did. Right? During that time, during the London kill zone, quote unquote. And you ride it to the 50% and the opposing end of the range. Right? That is a model by itself. But anyway, we're focusing on another one, which is the range opening price of the week, decline opening price of the day as well. So we're double discount. We're under the opening price of the week and the day. This is where the range is forming over here. Range, turtle soup of the range. Classic, you've seen me do this a million times, and you will see me do it 10 million times more. Turtle soup. As soon as we break that high, the low is in. The time and the price are both blending in together to form an excellent opportunity for low. Right? No high was ever broken, by the way. Up until this point. Rejected. Not even traded to. FVG. Rejected. Broken. During the time, which is Monday, we've taken the Monday low. We're below an old liquidity pool. We're below the previous week's low. 3 candle formation, remember? Accumulation, manipulation, distribution. Week 1, week 2, week 3. Right? All of this blended together gives us a chance to either hold till here, or you can also keep holding from that small range down there. You're using the 4-hour candle and the 1-day power of 3 with a higher time frame target at a higher time frame key level. This is all happening at the weekly order block, right? It's incredible when you realize what you can do with this if you're focused enough to do it. You got this over here. Check this out. At the key level, the timed range model, this is for the notes, and this is one down. Apart from the week one, of course, that's another timed range model, which is week 1, week 2, week 3, right? So you're taking week 1, week 2, week 3, right? Up until we completely harmonize, is that a word? Harmony is delivered to this candle. You see that beauty? From this candle, turtle soup, this weekly candle, Monday range, Monday low to high, over here, and bingo. This is all happening within this one candle, you notice? Do you see how clean it looks now? You've probably never seen this before because nobody has ever spoken about this model ever before, and I predict that many people are going to start talking about this model after this recording, which is using the candles themselves as targets, right? Looking for buys until we hit this. All of this is happening within this one candle, right? The higher time frame, we're looking for a lower time frame range during this specific time, Tuesday, after Monday's range is choppy, to fulfill this candle's destiny, which is taking it from the low to the 50% to the high. And that is two extremely important concepts, which, there you go, you have it. If I stop right now, then I have done the job with what you've learned, which is incredible. But I'm going to keep going. By the way, same thing here, right? Monday plays out. Where's Monday? I haven't even seen this, and I know how it's going to play out. Monday range, right? Yeah, Monday range right there. Monday range. Important liquidity pool. Market profile breaking highs. Dump below the low, rejection. Monday low, accumulation. Manipulation. Wednesday looking for buys, 3 candle formation, remember? And bingo. Using timed ranges. Blending those with the 3 candle formation. Some people say 4, I prefer 3. And blending this, if you've noticed, I've never mentioned a single PD array. I've mentioned maybe a higher time frame key level, only monthly, weekly. But on lower time frame, it's mainly lows. I'm mentioning ranges, breaking of highs, rejecting of lows. That's how pro order flow, right? And of course, a classic intermediate term higher low flip. Just a beautiful classic sight, right? That's the weekly range. Again, weekly open, declining below the weekly open. Every single buy when you're bullish is below the weekly opening price. Every single sell is above the weekly opening price, right? Weekly open, smacking back into the weekly open, timed range, soup, 50%, opposing end, bingo. Flipping the range, breaking out of the range. Ranges are either turtle souped or truly broken. And if some of this is flying over your head, by the way, and you haven't taken the first one, then I would really recommend taking the first one. And going through my material as well. That'll be helpful. So yeah, that's the weekly range. That's the weekly range defined into a 3-candle formation: Monday, Tuesday, Wednesday. What if Monday expands? You do nothing. What if it closes below the low? Then it's a real breakout. You follow the trend, right, through a deep retracement, or you simply wait for your model, right? Next up is the the daily candle. Now, speaking more on the candles or ranges thing, let me just go back to Bitcoin a bit. BTC, USDT. Let's go back to Bitcoin and let's see what happened here. Candles or ranges. And this is something I didn't want to really share with anyone, but you got it. You got it. We've been working inside of this range of this specific candle this whole while, which is why 32,000 is the goal, right? Almost there. We've hit the, have we? Almost. We are almost there. If you've noticed, candles or ranges, we're still working inside of this candle. We've not left. These are all inside candles. This is all price action happening within the main. This is the bias. This is the draw on liquidity. This is why when some goofballs on Twitter were trying to call a top over here, they failed. It is precisely because of this. Because of this concept of mine, right? This candle was a range. This range was truly broken, closed above. When we close above a candle, we expect higher prices. That's it. And I'm going to sneak you all one. The thrust candle is a good stop loss. Anyway, we bang into this range. Candles are ranges. Close range. Retest the range under the pretext of an FVG or an order block, whatever. It's simply a range. Opening price, slam into it, rally. This one, falsely broken range. FVG, quote unquote, right? And we smack right into, we work through the candle. Good old 1, 2, 3. And this is for your homework. Check what was up here. You're probably going to find a range. The classic range you see me draw all the time. Higher time frame, PD array, key level, quote unquote. 1, 2, 3. Anyway, you got this. We're working within this candle. We're targeting 32,000 US dollars on Bitcoin, right? Probably something like this. I'm assuming. Now, let's work this idea on the daily range. First of all, let's discuss the daily range. The daily range has been divided into two it's been not divided, it's been described, let's say. It has been described into, oops, look at that. You know what, let's check this out too. Candles are ranges. Let's go to the weekly. What is this? This is a range. Turtle soup at the lower end of this range and at the upper end. So turtle soup here. Each one takes us to target 150%. That is a super important note. If you reverse engineer your trades, especially the break-even stop losses, you'll notice that a lot of the mistakes come from not taking partials at the 50%. Turtle soup, breaking above the candles range, and then retesting this range and going higher. It happens all the time. It happens all the time. Now, disclaimer, do not try and use this without understanding order flow, otherwise you're probably going to fuck it up. Market profiles, order flow, and chart time. Which is why I didn't really reveal this thing until now. Except after putting out first the market profiles and now putting this on. Anyway, I had a very specific one. I've been kind of outside the markets, to be honest, lately. However, I did have a specific trade I had shared with you all. Same idea, by the way. Let's check this out. This is one specific candle, right? This candle is smacking into the slow, right? So in everyone's eyes, it's a market structure shift. So this one specific candle, we're going to work inside of it. Not a random candle. The candles that dig into the lows. Mondays, week 1. The Asian range, right? When it's ranging, etc. This specific candle, we are working through it, right? So we've, even this one, by the way, this one, I think this is the one I traded. Right up here. Before I go into this one, let me remind you of the anatomy of the daily candle. It's been divided into many ways. You can either use the 0, 6, 12, 18, the 6-hour candles, which I don't like so much. You can use it. Or you can use the 1, 5, 9, 1, 5, 9. Right? Let's go even deeper. Of course, this being 13, 17, and 21. All right? What does this mean to you? These are the opening times of the 4-hour candles. I've mentioned before that in these recordings that the opening times are fixed and the closing times are fixed. So that's 50% of the equation solved already, right? But using this concept, this frees you from the kill zone mentality because you know what the kill zone means. There's a candle which opens at 1 o'clock, 5 o'clock, 9 o'clock, 1, 5, and 9. And isn't it funny that the ICT kill zone is 2, accumulation, 9:30, and 1:30? It's kind of strange, no? Yep. It is. This is partly the reason why ICT has introduced the idea of the 9:30 Judas. Why? Because 9 to 9:30 is accumulation. I've brought light to this cycle, if you'll call it, right? Which is 9 to 9:30 accumulation, 9:30 to 10 is manipulation, and 10 to 10:30 is distribution, right? With a plus minus 5-10 minutes. Macro 9:50 to 10:10 macro, whatever that means. So bearing in mind these numbers, right? If you look at the tweet attached to this recording, right? I'm not sure if I can find it, but it was one in which he mentioned, and I must give him credit for this, to inspire the thought, when he mentioned that when you look at the 4-hour candles and the 1-hour candles through a lens of power of 3, then a whole new world opens up to you. A glimpse of that, of course, is this right here. We're ranging, right? Consolidation. Nine o'clock is the time the candle opens. News embargo, they said. 9 o'clock, the candle opens. We're working through that specific candle. We have dug into an old low, right? If you notice, even on the 10-minute time frame, or the 15-minute time frame, we're still working through this candle, by the way. We haven't left this candle, right? This specific candle, we have not left it. We're still working inside of this one candle, right? If you look at the 1 hour, it's the same exact thing, right? So we open the 4-hour candle, we dig into the low at 9:30. We close above the candle. When we close above a candle, we expect higher prices. Order block confirmed and rally, right? I'll tag a couple more examples, but this is my favorite way of using the 9:30 manipulation or the Judas swing through the context of the 9 o'clock open of the 4-hour candle, right? Over here, you got this. You got chop, 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 chop fest, chop fest, chop fest during the previous 2 candles. All right, if you remember, 3 candle pattern of accumulation, manipulation, distribution, accumulation, manipulation, time for manipulation, and distribution. Right? A more recent example, NASDAQ 100. Same exact thing happened over here. Even though it's been a while since I've looked at the indices, I had watched this one, I think it was last Friday, if I'm not mistaken. If I'm not mistaken. Here, let me make sure. It's been a while. Let's take a break as I look through the trade. The trade was indeed during the 21st of July, which is a Friday. Yep, I was right, as always. So you got this Friday. Let's go to the 1 hour. NASDAQ. Gorgeous. Now, we have come to another important model, if you will, which I've mentioned before, right? But before I mention it, let me just apply this once more. What do you see over here? And again, this trade will also be quoted. What do you see over here? Within this candle, we're trapped inside of it, right? We are working our way within this 4-hour candle. Range high, range low. A timed range, whether it's the previous thick 4-hour candle digging into a low, right? That's a criteria. Whether it's Monday, week 1, whatever. The Asian range, whatever. Let's mark 9. And this is a time that works best with the indexes or the indices. For Forex, it's better to use 1 a.m. New York time. Right, usually by 3 a.m. the swing point has formed. Right? We'll get into that right now. But right over here, 9 o'clock, you get that accumulation. You get the manipulation at the time designated for it, 9:30. At 9:30, we tap into the high of that specific candle we're working inside of, right? So whether you think of it as the previous day high, which is an excellent proposition, or you think of it as the 4-hour candle's high, right? You got this, you got a rally, turtle soup, market profile, down, breaking lows, rejecting highs, any pop-up of highs, but to be so smack back down. You got this, 9, the time, chop fest, 9:30, rally, and decline into this market maker sell model, original consolidation, and of course, the classic final fake pop before the equal lows. That is also a model by itself. You've been given like, I don't know, 3-4 models already. Another classic model is, if you want to talk about pattern, market maker model, right? Equal lows over here. And on the way on the sell side of the curve, right? Equal lows. On the sell side of the curve, before hitting the original consolidation, there's going to be a pop above an important high. Before collapsing, this suckers in a lot of people. That is a model by itself, right? The same applies to 130. This exact same model is happening at, you remember, 159. 130, well, you can really say 1, but 130 is the time for the manipulation to happen. Starting from the 1 o'clock 4-hour candle, we're hitting the previous 4-hour candle's high, and here comes the breaker, right? Sounds like a breaker? Here's a breaker for you. FVG, order block breaker combo. But I don't really pay attention to that. I'm paying more attention to the highs and lows and the time it's happening. And the market profile, breaking lows, popping above a high, opening price. Remember the criteria of being bearish? We sell above, we wait for a rally above, when we're bearish, right? This is the narrative, the context, range high, range low, draw on liquidity, sell side of the curve, 9 o'clock manipulation, 1 o'clock manipulation, 1:30 is the time designated for manipulation, right? You got this. Opening price, a fixed opening time, rally, creating a range, distributing into a key level above a high, bearish market profile, and smacking back down into the low. This is the model. And it is fractal, it is universal across all time frames. Right? Now, this is the 9:30 and 1:30, which are the times I usually like to trade if I'm going to trade intraday. Right? And this is how I do it. What about London session? Pretty much same thing, right? 159, 159. Some people like to use a 06, 12, 6. I don't know. I don't like it. I'm more used to this one. If that one resonates with you more, then who am I to tell you no, right? At the end of the day, the goal is to take your model, the one which you resonate with, whatever I say, I can say whatever I want. But if you resonate with a model which I don't, that's fine too, right? As long as you make money, you are not wrong. Now, why didn't this high pop up here? Why didn't it keep going? Well, because we are now on the sell side of the curve. We're profiling the market, right? Remember what I said before at the beginning, which is price levels are useless. Let's write that down. Good old quote. Price levels are useless until the time is considered. Time is useless unless we are at a key level. And by the way, this is a mid-study announcement. Whoever brings the best notes, right? Because my teaching style is a bit overwhelming, I can understand, but that's the way my information is fired out, and it's produced pretty good results in the last one, and I'm expecting no less from this one, especially with what you've been given. The best notes of the whole thing get a prize of $126. I'm waiting. Now, let's look at finally the example of the 1 o'clock open and how you can use that. And then touch on rejection blocks, and we wrap this up. All right, folks. Blending time and price theory. All right. You've seen me mention before that I like to see a thick, high volume candle. Right. And also you've seen me mention that most rallies end in an engulfing candle in the direction of the rally. Right? Cool. I'll let you ponder on that one, and I'll give you an example. Check this out. Over here, over here, over here, ES monthly, over here, over here to an extent, over here, right? It looks like cherry picking until you realize that this is what has been called live, and will always be called live, because it's simply the way price moves, right? So I mentioned before that looking for a lower time frame range at a higher time frame candle at the correct time, what does that look like? And see this? 3 drives. We're getting an engulfing candle above an old high in EU. Into a key level, right? Into this key level. If you look at the daily time frame, it's a lot cleaner. You got this on the daily. You got an FVG that was filled. Now, some of you think I trash ICT, but I don't. I respect his work. He's probably done the most service to the financial markets and disservice, to be honest, than anyone else, right? I mean, the way he's taught price is incredible. Even if it's copy pasted from others, it's a good study. So we're at a key level, a higher time frame candles range, right? You got this candle high, candle low. Has been hit? I think it has. And if it hasn't, then it will be hit, either it or its SMT equivalent, right? Candle high, candle low. Especially if they disrespect this weekly FVG, then the plan goes as planned. So above the higher time frame candle, we're looking to blend time and price, right? We got a range, a classic range, range high, range low. And let's see what happens over here. Let's see if we get the good old pattern. You see how difference it is? Do you see the difference between the patterns I'm talking about and the patterns that are spoken about? You got this beauty over here. You got the Monday range, remember? Timed ranges. You can do this same exact process with the Asian range. But let's focus on the example. You got this. You got the weekly open. When we're bearish, the important thing is hitting, as I mentioned before, the summary of all this is open, fixed time. If you're bearish, open, rally, key level, decline. Bingo. If you can do this thing, let's make it a bit more professional, a bit more presentable, right? Opening time. And let me add a twist to it. Let me add something which will make it interesting. Previous candle and a key level at the same time. How does that sound? Previous candle and a key level. Now, this is when time comes into play, especially in if you're going to trade the majors. If you're going to trade the euro, the euro dollar, which is what I trade. I trade the euro, the pound, the dollar, BTC, and ES. Mainly ES, EU, and BTC for swings. Right? So, this is the daily candles fixed open. This is the manipulation time, true open, whatever you want to call it, right? This is another timed model, which you should look into. Asian range. At 2 o'clock a.m., at 2 o'clock a.m., you're looking for a rally into a short-term high, 15-minute, 5-minute high, and you ride it to the opening. You're looking for a rally above the opening price, into the high, and back into the opening price. How does that sound? Going back to that. That's literally spoon feeding, putting it in your mouth. Taking my spoon and putting it right inside your mouth. You got this. This is a model, which was mentioned, by the way, by good old ICT. I have a twist to this, which is we've closed below the candle. We've left an FVG, and the FVG is the high, right? Accumulation, whether it's week 1, Monday, whatever. Manipulation, distribution, right? That was a little side rant. Let's now go back into the current example. Remember the timed range? Monday timed range. Monday. Tuesday opens, right? At 2 o'clock, we get a rally. So, without even knowing the bias, or the higher time frame bias, which is, I do not advise that at all, right? If you can't trade the higher time frame bias, then you probably shouldn't be trading the lower time frame bias, right? Unless you master the higher time frame bias, it doesn't make sense to master or even try and trade the lower time frame bias. You can practice the lower time frame bias, but when it comes to trading actual money, then start with the higher time frame. Anyway, accumulation, remember, manipulation, look for sells on Wednesday, distribution, 3 candle formation. The same model I spoke to you at the beginning, using the timed range, using the weekly open, we're rallying above this range. Into a key level, right? At the higher time frame candles high. Accumulation, manipulation, distribution. Accumulation, you can say that Friday was also accumulation. Remember the 2 forms I gave you? It's either like this, or it's accumulation, manipulation, distribution in 2 candles, right? But it's not important to understand the pattern. It's important to understand the logic of taking this candle's high to this candle's low, breaking through the candle, and then retesting the candle and accelerating away from the candle. Do you see how much more sense it makes? And this is not some hindsight garbage. This is exactly the logic I used to call this top right here on the US dollar, if you remember. Literally call the top right over there, using this exact framework in mind. It was the first time I took a trade on EU based on the dollar analysis. I was leaning towards a bearish dollar, a bullish dollar rather. As soon as we started probing above the high of EU and the low of the dollar on the weekly, right? As soon as we started attacking this high, then I suspected some distribution and a fall back down into the range, either to retest the range, but a fallback was necessary, either to retest or to continue downwards, right? Yeah, that's the London model. 1 o'clock. Remember the numbers mentioned in the previous video? 1. And go to the 5 minute. The best time frame to trade the daily range for me is the 5 minute. 15 max. And the weekly range is the 1 to 2 hour. Right? Just gorgeous. Gorgeous. Looking at it blindly with no time in mind, you'll see this. Let's hide. You're going to see a bunch of noise. But if you look at it through the lens of timed ranges, taking a range to a range, you're timing a range, you're breaking the range into a key level, and you're declining. Right? And bingo. If you remember the sign, one of the signs I mentioned of a true breakout, as a side note on price, is you get a sudden fallback in and then an acceleration, right? Which would happen over here. I'm still holding my position from up here, which was into a rejection block. Into a rejection block. What is a rejection block? It's an order block with a long wick. Bingo. Enigma solved, right? Nope. Wrong. Maybe, right? But it really is that simple. It's an order block with a long wick. Let's start with an example on the lower time frame, on the higher time frame, excuse me. Although there's an example right here popping out. You should be seeing it. Right? Why didn't this high get taken? Because of the rejection block. Right? But let's first go to the let's go to higher time frame. Let's go to a higher time frame rejection block to understand how it works. And this is a bonus. I was not planning on talking about this, but you got it. And speaking of Ethereum, let's go to the weekly again, applying the same candles or ranges concept. right? If you remember, I call the tippy top of Ethereum right at this high, right? We are above an old liquidity pool. A thick, nice, bullish candle has been created, suckering in everyone and their mama and their sisters, if they have any. And at the top of that candle, right, you see this, I'm working with this one candle. I'm working right inside of this candle. I'm looking for a false breakout to occur at this candle, falling right into the manipulation phase of the monthly candle, by the way. 1 hour time frame, looking for a range to form, a smaller time frame range to form above this candle. And if you can even look back right over here at the false breakout of the range, I said boom, this is the top. Some more tools to aid in the top are the standard deviations, obviously. When the previous candle has been ranging, there's a lot of material on that online. Maybe I'll talk about it later, but not in this one. It's not the topic at discussion. Projections, right? Fibonacci projections, whether it's the 1618, right? Whether it's the minus Fibonacci levels, right? Which is deviation. And of course, the classic way, which is checking for closes versus wicks, right? That's a lot more manual way. Checking for change of state of delivery at a certain time ranges, which will of course give you a high confidence that the top or the high or low of the day is in. I will link some more material which helps with this specific thing, which is the high and low of the day. But for now, let's focus on rejection blocks. This is a rejection block. Why did price stop here? It stopped at the wick of the order block. You see? You can almost say the open of the order block. Right? In classic support and resistance level, by the way, support and resistance theory, this is a support level. This is also a support level. Right here, you see? This is a rejection block. And that's the high. Rejection block, I say it with a quote unquote, right? Because even in classic support and resistance theory, this idea exists of the rejection block. But anyway, we came here to see, let's see some more examples. The daily, right over here. Now, why did these equal lows get left over here? How can you trust this? Right? It stopped at the rejection block. And this is common knowledge. It's not like some new science. A nuance, which you probably don't know, is the candle. And before I finish, or you can let that one go. Let it be. A nuance, which is not very known about the rejection block, is that the candle beside the rejection block is usually going to be taken. Right? The low or the high if it's the other way around. Now, it's not really a healthy way to look at it. That induces a thinking like this right? It's gonna force you to try and really catch this little. You're gonna try and force a rejection block. You might try and force equal lows to be created, as happens with any new concept. How do you predict this to happen? By the simple use of an SMT, right? This is one of the uses of SMT, is you use it to expect rejection blocks, and they happen all the time, to expect rejection blocks to hold, right? You got an SMT here, right here, right? SMT, and you got, in Ethereum, by the way, SMT here, which held the rejection block over here. So, why did it leave equal lows? Because of the SMT, right? SMT equals rejection. Let's write this one down. SMT equals rejection block equals equal lows left, right? That one is for your for your notes. How do you trade a rejection block? The same exact way you trade an SMT. You either wait for a change in the state of delivery, which is a close above a bearish candle on the lower time frame, while violating a bearish PD array, right? Trusting the equal lows to hold. Now, me personally, I like to wait for the actual, I like to trade the turtle soup candidate. So in this case, I would trade Bitcoin over here. This is my personal preference. You can do whatever you want, right? But that is, that's the idea. And speaking, one last touch on rejection blocks is as follows: Euro USD. My entry here was a rejection block. However, I'm pairing the rejection block as a higher time frame PD array, 30 minutes, right? Look at this beauty. 30 minutes. Expecting a swing point to form, which usually happens during week 2 and 3 of the month, because time and price are both fractal. This rejection block, right, was a, if I'm not mistaken, there was an SMT divergence at that high, which induced my entry using the good old technique of, and before I zoom in, we all know that rejection blocks on the higher time frame are order blocks on the lower time frame. That's a horrible, disgusting handwriting. I'm gonna have to do some justice. Rejection blocks on the higher time frame equals order blocks on the lower time frame. All right, let's mark that out over here. Order block, criteria of an order block: thick, heavy FVG displacement. Yes, this is the order block right here. I'm blending this higher time frame key level, the rejection block, with a turtle soup. That was the logic Panic entry plus the SMT gives you that order block on the lower time frame was a rejection block on the higher time frame. It's always the same thing. Never changes. That was my turtle soup entry using a rejection block entry on the higher time frame. Blended with that short-term lower time frame high, right? Everything at the specific time. Now, how do you trust this high to hold, by the way? When expecting a classic sell-off or classic sell candle, right, or in bearish conditions, it's a good idea to trust the London highs as stop loss, or the Tuesday lows, Tuesday highs and lows, right, or the week 2 highs and lows, as we've seen before. And now we move on to the common mistakes. Common mistakes. Let me check my notes. Common mistakes are, first common mistake is not back testing enough. So you watch this thing once, you say, hey, I got Enigma. Nope. Backtest enough. Backtest once, twice, 3 times, 4 times. For those of you who are professional in a certain field of life, you will understand this better than others. Is the more you practice, the more nuances you discover. The head movement, the telegraph, all these small, the details which come only with intense amount of practice, which comes from discipline. That is the only way you will master a model. Not by watching my video once. Not backtesting enough. 2 is not forward testing enough. So you just backtest and you find a 90% win rate and you fuck up. Oh, fuck you. Number 3 is, oh, fuck you, of course, meaning you're not going to make it. It's not a reasonable thing to do. Except if you want to play around, then sure. Expecting, this is an important one, expecting a ranging candle, expecting a trending candle, and being surprised by a ranging candle. How do you avoid this? You avoid this one by always taking partials at important highs and lows and at 50% levels. Because no matter how much knowledge we have or we gather or we acquire, we're still human after all. Right? So you can't expect to be correct 100% of the time. Because the knowledge is concrete. Everything is as it's supposed to be. But are you disciplined enough to choose the correct PD array? Are you disciplined enough to 100% probe the order flow due to your protocol? Probably not. Trending candle during a choppy candle, and vice versa. Number 5 is shorting every fucking high and low. Shorting and longing random highs and lows. You must understand the concept, and rewatch this if you have to. Timed ranges, whether it's the Asian range, or the Monday range, or week 1.
right? Monday range, week 1, or any other candle you're trying to work with, or some 4-hour candle, right? Study the examples I've called many times and will call and have traded and will trade. Of course, I'm not perfect. I might make some mistakes, contrary to popular belief. But try and, especially as a turtle soup, quote unquote, trader, you're trying to, what you're trying to do is enter once, right? Especially if you're trying to enter at a, if you're trying to soup, if you're trying the 3 candle pattern, which I showed you, or the 4 candle pattern I showed you, you're trying to enter once. So try and plan for your trade before just randomly pressing the button. The best trades, as I've said before, they come after a long, long wait and planning. So this, of course, can be easily avoided by your checklist, which is a higher time frame PD array, and are we above the opening price of bearish or below it of bullish? Above it, below it. Where are we? What's the ADR look like? What's happening with these standard deviations? Although I pay less attention to them, they are an important. They're not important. They're a good tool to have at hand. Are we in premium or discount? Premium discount. PD array. Are we high or low? Right? High or low? What's the market profile? What is the market profile? Right? If you just take the higher time frame PD array, right, and the open and the market profile, those 3 will save your life, right? These are the common mistakes that come to me at hand. Nope. Another one is expecting a false breakout and getting fucked with a real breakout, getting surprised. Let's be PC over here. Surprised by a real breakout. Again, go up right here. What's the logic? What's the narrative? What's the bias? Don't just say it's going to go up and down. Why? Are we high or low? What's the market profile? What's the narrative? Why should we go high? Why should we go low? And then, are we going high? Are we going low? These are a few common mistakes that come to me right now. And this concludes the videos. What can I say? It was a bit longer than expected, as usual. I will drop a guideline. I'll try and edit these videos into a link to make it kind of unreachable for those who want to leak it. And even if they leak it, they're going to have to go and open the link and study. And at that point, you know, they're probably going to get bored. Because the type of people who are trying to get the leaked content are not the type of people to stick around and try it out and really work for it. The amount, right? There's some chitter about the amount, right? It's a fairly, it's nothing to me, right? It really is, it doesn't mean much. It's simply a symbolism for you to invest in the knowledge you're trying to acquire rather than the price itself, right? Which is why it's fairly low. So it's a low entry barrier. right? So most people can have a taste. And don't forget, the best notes gets $126. I'm waiting for that one. Submit to the secretary. Any questions you have, check the pinned comments in my Telegram account. And if I have any additions, which I probably will have, I will add them to the Time and Turtle Soup group. But for now, this is all. This is 99.9% of what I intended to share in this teaching. Any questions you have, again, talk to the secretary, and they will send me the most frequently asked questions. Happy studying. Backtest, forward test, find your own model, trust your own model through my information, and good luck and good trading.